Hi everybody, welcome to our webinar. Come on in and take your seats, make yourself comfortable. We'll be kicking off in about a minute, just giving everybody time to come in and get set. Hopefully you've got a cup of tea or some lunch ready to go in a nice warm spot. It's a bit cool today. So thank you for everybody for joining us. I'm just going to give it another half a minute or so for a few more people to come on, and then we'll get started for our webinar. Still got a few people coming in, so I'm just going to give it another 20 seconds whilst people are getting set. Okay, welcome to the Evalesco webinar on what happens next. To those of you returning, thanks for giving us another chance, and welcome along to our first timers. My name is Jeff Durack and I'll be your host for today. While we don't have a crystal ball and I don't make any claims to having any special powers for seeing into the future, we're very fortunate to have access to a lot of smart people and detailed research, which we can use to consider the various paths that may be available to us as we emerge from our enforced hibernation. And today we're going to discuss those options across a few of the key pillars of a financial strategy. So please sit back and make yourself comfortable while I take you through the current state of play, possible directions, and some key considerations across property, spending and saving, superannuation and insurance. And that should take around 20 minutes. We're then going to be joined by our special guest, Michael O'Day. Michael is the head of multi-asset at Perpetual and one of the smartest and most informed professional investors that I know. So Michael's going to talk to us about global economies and investment markets and how Perpetual are positioning our portfolios and thinking about the way out. And we'll then wrap up with some questions. So if you have any questions on the way through, please type them in the Q&A box, which you can see down on the bottom of your screen. Michael and I are going to try not to look at them as we go along so that particularly I don't get distracted, but we'll endeavour to get to as many as possible at the end. It's important to point out that even though all, or at least most of you on this webinar are clients of Evalesco, the information provided in the next 45 minutes or so doesn't specifically consider each of your individual circumstances, so it isn't personal advice. If you think you should be acting on something we discuss, then please speak to your advisor first. Now, we all know it takes a lot to knock property off the front pages of newspapers and the top of the list of dinner party conversations, even if it might be over Zoom these days. But the COVID-19 pandemic has done that. Nonetheless, Australia's love affair with residential property will continue. And right now, there are a lot of different moving parts in the property sector that can have implications and can create opportunities for people at all different stages of participation in property, be that renting, as a landlord, looking for a new home or investment property, or looking at the best structure and rates for your mortgage. The first big question really is, which way is the property market going now and over the short to medium term? I think it's important to first acknowledge that there isn't just one big property market, but there are many different markets around Australia which will behave differently at different times, and we'll touch on some of the driving factors. However, economists do like to make bold statements and to aggregate them into one market to make a headline. You know, realistically, if you get 10 economists and property experts in a room, you're probably going to end up with 12 different opinions on the property market. Right now, many economists are saying residential property is in for a tough time, with the major banks all predicting falls of at least 10%. On the flip side, there are a few experts and commentators taking a contrarian view and are saying conditions are right for continued growth. In most markets across Australia, prices went up in April, only marginally. And according to CoreLogic, which is a prominent property-focused research business, over the 12 months to April, national prices in the combined capital cities have risen by 9.7%. So one of the experts who's looking at the property outlook more favourably is Christopher Joy, who's the Chief Investment Officer of Coolabah Capital, and he's also a regular writer for the Australian Financial Review. His base case is for Australian house prices to flatline or fall by up to 5% over the next 6 months, and then quickly bounce to extend the boom that commenced in mid-2019. So he expects total capital gains this cycle of between 20% and 30%, and that's driven primarily by the reduction of mortgage rates to record low levels. He also sees the current reduction in sales volumes and listings as support for the challenges of the lockdown. Another potential positive for property is that in an uncertain time, some people feel more comfortable with bricks and mortar, particularly over the seemingly more volatile share market. So that could lead to an increase in demand as well. However, there are clearly some areas of concern which are driving the more bearish outlooks of the banks and many commentators. The biggest impact in property could be in the rental space. There was already a little bit of weakness in rentals earlier in the year, and as Australian borders remain closed to tourists and as the government policies restrict short-term rental arrangements, this has led to other changes, things such as Airbnb rentals converting to long-term rental supply. The added supply means that rents could go down, and we've seen some stories in the newspapers and online this morning covering off some of that. This is also compounded by a decline in demand. Rising job losses are seeing some tenants negotiate lower rents or find alternative accommodation, such as choosing to move back with parents. A pause on the flow of international students and migrant numbers could also see more properties sitting empty, while domestic students may be less inclined to rent close to universities as they access study remotely. But the impact on different regions will vary depending on how exposed they are to tourism and migration and job losses. Several data sets point to inner Sydney and Melbourne being the most affected. CoreLogic's data estimates that between March 22nd and April 26th this year, the number of properties for rent in the inner city regions of Melbourne and Sydney have risen by, in this very short period of time, by 36.2% and 34.1% respectively, which is huge. So these are the typical blue chip investment property areas because they're popular with city-based workers on higher, more stable incomes, usually. And that may continue to be the case over a longer term. And we know that property investing is always a long-term strategy, but in the short term, there may be a little bit of pain. So now it's potentially a good time to be looking if you're a renter, but possibly tougher if you own investment property in these areas. And it's hard to know if it will last or bounce straight back once restrictions ease and we all get back to the office. It'll be interesting to watch how this progresses over the coming months and if it has any impact on property prices in these regions. Another key consideration for the property market is access to finance. So with the reality of job losses and reduced incomes kicking in, more people may be restricted in their ability to borrow money or to borrow as much as they would like to. Some banks have increased the vetting of proof of income in recent times due to increased concerns over the sustainability of income. And the mortgage industry reported that around 75% of lending activity last month was for refinances, with purchase approvals well down. And that makes a lot of sense. Uncertainty and some of the difficulties in viewing properties has led to a drop-off in the sales. ANZ Bank CEO Shane Elliott said last week that he thinks a lot of people are sitting at home thinking that the future is a little bit more uncertain than it was. We should probably look at where we can save a few dollars here and there. And we couldn't agree more. Interest rates are near historical lows. There are some fantastic opportunities for both variable and fixed rate loans at the moment. So we'd encourage everyone with a loan to be reviewing the terms at this time. The other upside of having your finance strategy in order is that it can open up the possibility of smart, opportunistic purchases. With less people looking to buy, people who need to sell will be drawn to those who have their finance in order and they can move quickly to finalise the sale. We've seen several examples of clients in the last 6 weeks who'd been looking for properties for a while, both for homes to live in and for investments. And with the challenging environment, these clients were able to negotiate significant discounts on purchases because they were ready to buy and could move quickly. One word of caution though, when it comes to loans, cheapest isn't always the best. It's important to make sure that your lending structure supports your strategy, which could include things like paying down debt on your home quickly, saving for other purposes while reducing your mortgage, or tax effectively managing your debt. And sometimes the cheapest loans don't offer the right supporting features. One area that raised its head in the last couple of weeks is in relation to redraw accounts versus offset accounts. We recommend to always use an offset account over a redraw account wherever possible. A blog post on our website written by Jules last week goes into a lot more detail on this, but the crux of it is by having cash in an offset account, it's clearly your money in your control because it's effectively a bank account. Whereas with a redraw, the facility is part of the loan and the bank has more control and could have some claim to that money. We saw one bank change their terms so customers lost access to money they'd built up through additional repayments in a redraw account in the last couple of weeks. That bank has since bowed to public and government pressure and restored the previous settings, which is good news for those customers. However, it shows that the terms and conditions and the structure of the lending setup is really important. So we believe that strategy always comes first. If buying a property as a home or investment is a part of your strategy and your personal situation hasn't been negatively impacted, then it makes sense to continue to investigate that strategy. Having finance in place and the ability to move quickly for the right opportunity could be an added benefit for you. If buying a property is not part of your current strategy and nothing has changed, then the property story may not be so compelling to suggest that you should be racing out and looking for those opportunities. But if you are interested in exploring it, then have a chat to your advisor to work through why it may make sense and how it could fit in for you. As most of us know, there's been some rule changes and guidance implemented in relation to rent relief in the last 6 weeks. Those potentially impacted have probably already got their head around the implications for tenants and landlords. And there was a blog posted again on our blog last month by Jules, which I'm sure you've all read, that goes into that in a bit more detail. In brief, in New South Wales, the government put a 60-day stop on landlords evicting tenants due to rental arrears as a result of COVID-19. So to meet those requirements for relief, tenants have got to show a 25% or more reduction in household income. And there's certain ways they need to evidence that. If you're able to negotiate a rental arrears accrued, it will not automatically be waived. So it'll be subject to how the terms of that negotiation between the tenant and landlord are worked through. Landlords can also contact their insurers, as if they hold landlord insurance, they may have rent default cover that provides cover for loss of rent if the tenant defaults on their payments. And landlords with mortgages also have the options to seek help from their bank or their lender. And those options can include things like renegotiating the interest rate on your loan or locking in a new low rate, which, as I've just mentioned, is something we think is important to consider at the moment. You may be able to reduce repayments to the minimum or making interest-only repayments instead of principal and interest at the moment, as well as the option to request a repayment holiday in the case of financial hardship. And that's one that we would consider a last resort, because if you have a repayment holiday, the loan amount owing during the period of no repayments is increased and the debt levels go up, and therefore the higher interest charges apply over the long term. So that winds up our thoughts on property for now. Please post any questions you have if there is something you'd like us to come back to. We all know spending habits have changed over the last couple of months, and some of those changes are really well encapsulated in this data gathered by Accenture in early April. So there's no surprises. Spending on gyms, pubs, travel, public transport and cafes all fell off the cliff. And we saw some big spikes in spending in setting up the home office. I know I contributed to that one. And food delivery has taken off, while groceries only increased slightly. So these changes have been forced upon us, although I don't suppose anyone is really forcing us to spend more on alcohol. But as long as we can no longer access certain spending avenues, we're having to choose different ways of spending the money. For many, though, the changes have been more severe as they've suffered a significant reduction in income. So Accenture has been collecting the data weekly, and last week's results show that consumer spending increased by 13% on the week before, and spending per person is now about 7% below a normal week. And because people began to entertain at home last week, there was a jump in supermarket spending, which lifted 8% from the previous week, and alcohol jumped about 15%. Health spending also received a boost, up about 9% as people started to go back to appointments, including physios and allied health. And there were signs of people getting out and about a bit more. Taxis were up 6% and road tolls up 9%. So Accenture's commentary suggests that as we see restrictions further easing over the next few weeks, higher income people will also start to open their wallets for more discretionary items, which is something they have not been doing over the last few weeks. Before we rush back to normal and the same old, I think it'd be a crying shame if we didn't take this opportunity to review what we're spending money on, why, how, and if we want to keep doing that. Evalesco's approach has always been about spending money mindfully, and that rings true more now than ever. So we think you should take the time to think about what's important now and what will be important in the future, and allocate spending and savings towards those things. If it's not important, don't allow yourself to just continue to throw money at it. If you found a new hobby or passion in lockdown, that's great. Allocate some of your hard-earned to that and look to save elsewhere. Also, the last couple of months have really reinforced the importance of having a buffer of 3 to 6 months of living expenses in cash. So many of our clients have told us how only now they really understand why we've been banging on about that over the years. The idea behind the buffer is that in normal circumstances, to give you comfort that if something were to happen, you would have cash available. And for many, that something has happened now, and life is a lot easier with access to cash. So if you haven't got 3 to 6 months of living expenses in cash, then now is a good time to make a plan. I suggest you start by directing any surplus money that you're not spending into a cash account, preferably in an offset account if you have a mortgage, or you might want to look at paying out bad debts first and then building up your buffer. If you're not sure where to start in reviewing your expenses, then try some of these options. We've already talked about reviewing your mortgage. I think that's so important and such an obvious one right now. So speak to your bank or your advisor and we can help as well. The other one's energy bills. They really do add up and prices have been climbing a lot in recent years. I fear we're all going to notice that a lot more given we're all at home and probably starting to turn the heaters on a little bit earlier in the day. The website energymadeeasy.gov.au is a really helpful site provided by the government to compare providers. So check it out as a good place to start the process. Insurance premiums are another creeper. It's easy just to pay your insurance premiums when the renewal comes through, or if it's on a monthly direct debit, it's even easier just to let it go on. So now's a good time to see what you're doing in those areas. Certainly we can help, particularly with life insurance, income protection and health insurance. We all know that health insurance is a really big one and premiums have increased so much in recent years, yet most people don't move their health insurance. Also, have a look for wastage. Most of us have things that we subscribe to or set up which seemed like a great idea at the time. Consider if it still is a good idea. Ask the question, how many streaming services will we all need when we are allowed out of the house? So to start with that, have a look at your bank statements and credit card statements and see if there's anything on there as a direct debit that you're not using anymore. And if there is, chop it. Also, have a look at your super. So Evalesco clients have this done for them, but if you haven't looked at it recently, review the fees and insurance premiums you're paying on your super. And while you're at it, have a look at your investment options and the asset mix and see if they are serving you as well as they could be. Speaking of super, we'll cover off on the investment aspects of superannuation portfolios where Michael comes up to speak shortly. But there are a couple of topical points in relation to super at the moment. So the first one being the early release of Super Scheme has been working now with up to 9 billion already paid out to Aussies. This is the extraordinary measure where the government is allowing up to $10,000 per person to be accessed from their super each of this financial year and next. That process is conducted through MyGov accounts and the ATO, and it's been working pretty smoothly so far from all reports. We see this as a really important measure for those in really dire need, but it isn't something to be taken lightly due to the long-term impact that it'll have on super balances. So I encourage anyone considering it to talk to their advisor. The other short-term relief is in relation to reducing minimum pension payments for those in retirement. Many of our clients have taken the opportunity provided through the reduced spending associated with being locked down and reduced their superannuation pensions. This is a really good option for those with a cash buffer and if you're not spending as much as you were. The minimum amount to be taken has been halved, so there's an opportunity for this financial year and next to keep some more money in super. And as mentioned earlier, another great use of surplus cash is to increase super contributions. If you're saving some more money, then have a think about putting it into super, and there are a number of ways to manage this, and it can be done particularly tax effectively. So again, speak to your advisor if you have some surplus cash flow. I spoke briefly about insurance in relation to ways to save some money. You should review your insurance annually because your situation does change and insurers do make changes and opportunities do come up. At the moment, we know some people are considering whether they can keep paying their premiums, and I'm going to talk about some strategies to manage that. But before that, I want to start by making an important statement. Insurers do pay claims. On this slide, you'll see a recent report from TAL, which is one of Australia's largest life insurers and a business that we do work with. As you can see, just last year, just this one insurer paid $2.3 billion in claims to Australians. 64% of that money was paid to people who survived their illness or injury. And hopefully that money will help them in their recovery, or at least to be more comfortable. You'll see on the slide that the most common reason for a claim is cancer, and that's probably not surprising. Mental health conditions is the second most common, and that's increasing more quickly than anyone would like. Insurers are also bracing for an increase in claims in this area as a result of the isolation, stress, and strain of the COVID-19 situation. So please all look after your mental health. So if you have debts, dependents, or dreams, insurance is important. If you are struggling to pay the premiums at the moment, there are a number of things to consider before cancelling the cover. First being to talk to your advisor. So we've been working with insurers on clients' behalf to implement measures on their existing policies, such as payment plans, which means premiums are reduced now, but paid back over a longer period of time. Grace periods where no premiums are paid for a period of time, and negotiating premium discounts or waivers or suspensions. Other options to consider are changing the ownership of your insurance policy. For example, some policies can be paid for by super. Another option is removing automatic CPI increases on your insurance cover that would normally apply on a policy anniversary. You could consider decreasing your cover because having some cover is better than none. So by analysing and prioritising the cost of and importance of various covers, you may decide to reduce the level of cover for a period of time. So reducing is easy. Increasing can be more difficult as it usually involves applying for an increase and going through underwriting. Some companies can give a temporary reduction in cover and allow you to reinstate previous levels without underwriting, which is a great benefit. You can also review any loadings that have been applied to policies. So a loading may have been applied when you took out the cover based on health or occupation or pastimes. If anything has changed there, you may be able to save some money in that regard. So as mentioned before, make sure you review your health insurance as well. We can put you in touch with a provider who can do a simple comparison for you. So please speak with your advisor about any of these points. So I'm going to now hand over the microphone to Michael O'Day. You can read a bit about Michael on the screen and see his smiling face. And I'd just like to reiterate that Michael is a fantastic resource for us. He's done a few presentations for our clients over the years and is doing an excellent job in managing money for our clients. As many of you know, Michael and his team manage the Perpetual Diversified Real Return Fund, which comprises 20% of the AAN core model. So thanks for being with us, Michael, and I'll hand it over to you.
Good afternoon, everyone, and thanks a lot, Jeff, for the opportunity to take part in this webinar at what has been a very unusual and difficult time for most people. The last few months has reminded me of an old saying, which is, if you're not confused by what's going on, then you haven't been paying attention. And quite simply, what we have seen this year is unlike anything that we've seen before. We've had oil shocks and we have had financial shocks, but we have not experienced a health shock, financial shock, and oil shock together. And if we turn to the next page, the one word most commonly used to describe the current situation by company management and their disclosures to shareholders is the word unprecedented. And the use of that word is up 10 times since 2 years ago. If we move to the next slide, there has been, updating for today, there's been over 4.3 million cases of COVID-19 globally, with almost 300,000 deaths. It took 73 days to record the first 1 million cases, 13 days for the second million, and 11 days for the third million, and 12 days for the fourth million. The extraordinary action to lock down economies and impose social distancing has worked to flatten the curve. But there is an enormous economic cost to this, and it was never a sustainable strategy. Arguably, a shutdown is most effective when a pandemic takes everyone by surprise because it buys time to build capacity in healthcare, it buys time to improve testing and contact tracing. Scientists can study the disease and develop treatments, but lockdowns are not the solution and can create other problems, as you can see in this slide here. In the US, over 20 million people lost their jobs in April, which is more than 10 times than ever before. And over 30 million people filed for initial jobless claims over a 7-week period. This has resulted in an unemployment rate of 14.7%, up from 3.7% last year. And this is likely to be understated as it does not include discouraged workers who have left the workforce. It's the swiftest increase on record and the worst since World War II, but it's not yet as bad as the Great Depression. But unfortunately, the unemployment rate is likely to get worse before it gets better, and many economists expect it to exceed 20% in the US before improving once the economy reopens. Turning to the next slide, the purple lines on the left-hand chart show the peak to trough fall in markets, with stock markets falling between 30 and 40% in a matter of a few weeks. The bounce back in markets has been equally as impressive, particularly the US, which has led the bounce, and it's now sitting at only 15% off its highs, despite having the highest unemployment rate since the Great Depression, hundreds of thousands of businesses being shut down, and a global pandemic, which we need to find ways to live with while we seek a vaccine. If we look at the chart on the right-hand side, the best performing sectors of the market have been healthcare and technology, which have recovered most of their losses. If we turn to the next slide, well, how does this compare to previous bear markets? Well, in the US, there have been 7 other bear markets over the past 50 years. 6 of these bear markets have been associated with recessions, and the average bear market was a peak to trough fall of 39%, and it took on average 16 months to recover these losses. The bear market that we're in today has been better than average in terms of losses thus far, but this crisis may be still playing out. If we turn to the next slide, why then is the market rallying when the economy is so bad? And there are 3 basic reasons to keep in mind. The first is that the stock market is not the economy. The S&P 500 is comprised of about 25% of tech companies and about 15% of healthcare companies. And both of these sectors have done very well during the crisis, supporting the index. On the left-hand side, you can see the performance in gold of the top 5 tech stocks versus the performance of the S&P 500 without these 5 stocks in it in the light blue. We turn to the next slide. The second reason is that monetary and fiscal support matters, and it matters immensely. The chart on the left shows that central banks quickly cut interest rates. However, the level of interest rate cuts was about a quarter of what was done during the GFC, and that was because many countries entered this crisis at zero or negative cash rates. But zero interest rates means that investors sitting in cash produce no income. And so in order to generate any type of positive real return, you need to be prepared to take risk by investing in equities or credit markets. The right-hand chart shows that the level of fiscal support this time round has been nearly double of that which was provided during this GFC. And there is a lot more to come, with the US Democrats in Congress proposing another $3 trillion of fiscal bailouts. What's more is the composition this time round is different to what was done in the GFC, and it's skewed more towards job retention, business loans, and direct cash payments. The Federal Reserve has also been expanding its balance sheet by purchasing financial securities such as US Treasuries. So far, they have bought an additional $2.3 trillion worth of financial securities over the course of a few weeks. And now they are buying corporate bonds as well as government bonds. And when a central bank who has the ability to print money steps in, prices are what they want them to be. So the US government will be able to borrow very cheaply at almost an infinite quantity. But I think in addition to monetary and fiscal support, there's another assumption at play on the next page. It's the idea that once the virus crisis passes, the economy will rebound very quickly and hit its old levels of growth. This is also the assumption that this V-shaped recovery will happen relatively soon. The more circumspect, like Niall Ferguson, worry that the US has done just enough to crater its economy, but not enough to control the pandemic. I worry that the current optimism does not allow for second-order impacts, such as on the next slide, such as corporate bankruptcies or an increase in real estate delinquencies, which are likely to occur given its historical relation to the unemployment levels, which is shown on this chart. The unemployment rate is in red and the real estate loan delinquency rate is in blue, and we're yet to see an uptick in the blue delinquency rate. The next slide attempts to break down what is likely versus what is very uncertain at this stage. We know that we're in a stage of reopening economies because we can't afford to keep them shut. Australia and New Zealand are the exception in that we've done very well in controlling the virus, but the US and Europe will likely experience problems. Improvements in contact tracing and testing will overcome a lot of these issues, but that does not mean that the consumer or business confidence will be restored immediately. It could take a few years to create the jobs needed to get back to where we were in late 2019. One of the things which keeps me up at night is the fact that we know the policymakers had to act to save people's lives, the economy, and to reduce financial hardship, but we don't know what the long-term impact of these decisions are. Will it result in lower productivity by keeping zombie firms alive for longer than they should be? Will it lead to higher productivity, but with fewer jobs because companies will turn to automation? Or will there be an increase in inflation down the road? If we turn to the next slide and the one after that, we have a product aiming to reduce inflation plus 5% per annum over 5 years called the Diversified Real Return Fund. And the way we think about building portfolios is to manage the risk we take through the cycle by removing asset classes that become expensive and vulnerable as the economic cycle matures. Early in the cycle, the portfolio has more invested in equities and credit, and then it increases its defensiveness as the market becomes more expensive. On the next slide, while we didn't pick COVID-19 as being the catalyst for the bear market, we knew that there were vulnerabilities. The US economic cycle from 2000 to 2019 was the longest on record. But despite its longevity, on the next slide, it was also the weakest economic recovery in history, and interest rates were kept at ultra-low levels. So while low interest rates failed to generate high levels of growth or to get inflation back to target levels, it did spur a huge increase in debt. And company debt to GDP was the highest ever, making them more susceptible to an economic downturn whenever it should happen. And the quality of that debt, on the next slide, was very weak, with 50% of investment grade debt sitting at just one notch above junk status. And we've since seen some very large companies like Ford being downgraded into junk status territory. On the next slide, it's often your portfolio outcome is determined by what you don't hold as much as what you do. And we entered this crisis with about 30% in equities, which is similar to a conservative fund, but we did not hold US or European credit. We also didn't hold any listed private equity or listed infrastructure or listed property, which each fell about 50%. We do continue to hold 5% in unlisted industrial property, which has actually benefited from the surge of online demand. In addition, we held a comprehensive range of portfolio defences, and that meant, turning to the next slide, that for the 3 months to March, the fund was down 2.5% versus about 23.4% for the ASX 300. And now the Real Return Fund has managed to outperform the ASX over all time periods for about a quarter of the volatility of owning Australian equities. The next slide shows the performance of the fund versus the ASX 300 during various periods of sell-off. And I note that over the last 10 years, there have been 4 occasions, not including the most recent one, where the ASX has fallen by more than 10%. And you can see in the dark blue line, the level of defensiveness that the fund's been able to achieve. The next slide shows longer term performance of the fund in the dark blue versus cash in the purple, and Australian fixed income in the red, and Australian equities in the green. So how are we positioning today? Well, there are more opportunities to achieve higher returns, but we still remain cautious as markets have a tendency to move to extremes. We're watching the US and Europe reopening carefully, and we're looking for any second order impacts. We're also mindful that defensive investments have done well, so it's harder to build a diversified portfolio today with bond yields at less than 1%. That said, we are opportunistically adding to equities and to credit. So to summarise, the next 10 years will likely be defined by the ongoing tech revolution. The pandemic is likely to accelerate automation as companies reduce the reliance on humans and seek to improve profit margins. And the Brookings Institute has already stated that up until last year, 25% of jobs are experiencing high levels of disruption due to automation. This trend's likely to continue. Secondly, how policymakers respond to this ongoing crisis is incredibly important. One way might be for the central bank to directly finance government infrastructure and welfare programs. They call this modern monetary theory. They are doing this indirectly at the moment through quantitative easing or buying the bonds that are issued by the government. The third point is the China and US relationship was already in a fragile state last year with the trade war, but it has now reached a new level of hostility, and it's likely to remain elevated through to the US election, with the US voter base either blaming Donald Trump for the pandemic or China. And you know what Donald Trump would prefer them to blame China. And then there's the last point, which is how clients are positioned. And we've been well positioned to protect capital to date, but we aim to continue to do that while looking for opportunities to generate the returns clients need to fund their lifestyles in retirement. So if I've left you feeling confused, there is an opportunity to ask questions, but at least you know if you are confused that you have been paying attention. Thanks very much, and now I'll pass back to Jeff.
Thanks very much, Michael. So I'm sure, as you can see from Michael's comments and his slides, Michael's all over the data, but still presents challenges for where to from here. So thank you very much, Michael, for taking us through that. We've got a few questions that have been sent through, which is great. We've got 5 minutes or so to answer those, so that's also great. If you have any other questions, now is a good time to fire away while we've got Michael here. So Michael, I guess one of the first questions that I'll ask of you that's come through is, there's a lot of talk about share markets being overvalued. You just mentioned that you've been opportunistically adding to equities a little bit in the portfolio. Some people are forecasting a further crash. Is this something that you're concerned about, or how are you seeing that?
Well, so we added equities and credit to the portfolio around 4 or 5 weeks ago, and it wasn't too far off the lows. Since then, we have trimmed some of the equity positions, and actually we've found ways that we could buy put options again, which help to protect the portfolio if equity markets were to sell off. That's essentially buying insurance, and that insurance was very expensive over the past 5 weeks, but it's now becoming a little bit cheaper to buy. So we are concerned that equity markets could end up giving back some of their gains in the near term. But I think that's going to present a great opportunity for us to reset the portfolio for the next 5 to 10 years and increase the weightings to equities and to credit quite significantly in the portfolio. Today, it's only around 20% we've got in equities, and I could see that going up to around 50% once valuations look more attractive to us.
Okay. And what do you think about the likelihood of the so-called double dip in markets? So we've had that one big dip, and now markets have recovered a bit. Is it likely we'll see another dip, or without having a crystal ball?
It wouldn't surprise me at all. And bear market rallies are fairly typical in this sort of situation, but there's a lot of variables that we don't know. One of those is how confident consumers are going to be getting back out there into the economy. If they end up saving more and spending less, then that's going to be a problem for the economy in aggregate. I think the other issue that we don't know about is how effective contact tracing is going to be. If there is a resurgence or a second wave of infections, how quickly can health professionals jump down on that and contain it? If they can do it quickly, then people can get on with their day-to-day lives with a greater degree of confidence. If not, that's going to cause issues. So I think there is going to be investor sentiment waxing and waning for the near term. But I also think it's going to be matched by an overwhelming policy response, particularly in the US. I think Australia has done a good job, but we also need to know what happens after September when the JobKeeper program finishes up. And so there's a lot that we don't know at this point. And in the meantime, I could see, a double dip is certainly possible, but it could also range trade for a period of time.
Mm-hmm. Okay. There's been another question that came through was just in relation to timing the market, I suppose. And there was some talk about people having gone to cash very early on in the pandemic and, still being in cash or going back into the market. You've talked about how you've been invested and seeing the potential for a double dip, but staying invested. What are your thoughts around getting the timing right? and staying invested as opposed to going to cash through these situations?
The way that we approach this with our fund is to manage the risk that we're taking throughout the economic cycle. So when valuations are cheap and the economy is in a recovery phase, we want to have maximum amount of risk deployed. So we own a lot more in equities at that stage. And so we do reduce the risk in the portfolio potentially too early. And we felt that last year, where earnings per share growth was negative last year. The economy was showing signs of slowdown, but the market was up 30% in the US. And yet we were, at 30% invested in equities. If we had have been, I think, more sensitive, about return management, we would have had more risk in the portfolio at that time. But it also means that you don't have the portfolio protection when you need it, when some catalyst that you haven't predicted hits you, like COVID-19. So we're happy to maintain participation with the market as it's rallying, but we really want to have that downside protection embedded, because we're looking after people who are in retirement or approaching retirement. So that's what we prioritise. We're not trying to get the day-to-day moves of the market right. We're just looking for opportunities where we can selectively add risk when the market is offering a really good return for risk outcome. And we've seen a bit of that when there was excessive selling over the last 5 weeks, but then there's been optimistic buying. And so we've just trimmed our positions and we're waiting to see what happens from here. And we will add risk as we can build more diversified exposures into our portfolio. Whereas at the moment, things are either going up or they're going down, and they're doing it together. And so I think you need to allow the market just to consolidate for a period of time before taking advantage in a more aggressive manner.
Fantastic. Thank you very much for taking us through that. That's covered most of the topics we've had raised in the questions, and we've come right to 1:15, which is when we said we'd finish. So we may as well wrap up there. Thank you again, Michael, for your time and your thoughts.
Well, thanks very much for having me.
No worries. And thank you everyone for listening, your questions. And if you have any further questions, please do send them through and have a chat to your advisor as well. In the meantime, stay safe. Thank you.
Thanks, everyone.